Welcome to Mex Movers by White Paper Media. I'm Damien Fraser, and along with my co-host Eduardo Garcia, we'll be decoding Mexico's business and finance scene every week for an English-speaking audience. Hello everyone, welcome to Mex Moves by White Paper Media. I'm Damien Fraser.
I'm Eduardo Garcia.
Today we're going to look into baseball and the recent IPO of Mexico's leading baseball team. We're also going to look at industrial real estate and the recent takeover fight for Terrafina.
And we'll also look at some of the controversies surrounding Mexican billionaire Ricardo Salinas Pliego.
And we'll end up with Mexican department store chain Liverpool, the largest in Mexico, taking a 49.9% stake in the US retailer Nordstrom, along with the Nordstrom family that took the other 50.1%.
So let me start, Damien, if you don't mind.
Go for it.
I'm going to talk about an event that took place on the balcony of the Mexican stock market last week. The famous Diablos Rojos del México, Mexican baseball team, for those who might not know it, which is owned by billionaire and former banker Alfredo Harpelú, celebrated, I'm going to say it, a historical moment by becoming the first Mexican Latin American baseball team to list its shares on the Bolsa Mexicana de Valores. It wasn't your traditional IPO, Damien, as you know. Instead, the team listed, in other words, registered close to 625,000 shares under the ticker symbol Diablos, with an initial price tag of 1,620 pesos per share, or 62% higher than their nominal price of 1,000 pesos. The trading price was established by an auction mechanism the Bolsa has to figure the price of shares that are registered on the exchange. With this move, the Diablos are riding the wave of a growing trend where prominent sports teams allowed fans and investors to own a piece of their legacy. This trend began in Europe nearly 2 decades ago, starting with Juventus, the Italian football club, which listed on the Borsa Italiana in 2006. It was followed by Manchester United, a team from your native country, Damien, in 2012, which went public in the New York Stock Exchange.
Not my team, I should say. I'm a fervent Chelsea supporter.
Ah, that's interesting. So you haven't bought any shares in Manchester United, I assume. Despite that, I don't know if it's done very well or not. I think it has its ups and downs. Yet, in Latin America, the trend picked up last year when Grupo Televisa, Mexico's largest television broadcaster, spun off assets, including its ownership of football team Club America and the iconic Estadio Azteca, the legendary venue for the 1970 and 1986 World Cup finals. The new company, called Oyamani, began trading in February, and its shares have done well. They've risen 17.9% since then, compared to a 13.3% drop in the main Mexican stock index. It doesn't hurt that Club America recently won its 3rd consecutive league championship, boosting fan enthusiasm, ticket sales, TV rights, and merchandise revenue. In that context, the timing of the Diablos Rojos listing couldn't be better. The team recently clinched its 17th Mexican Baseball League championship, ending a decade-long drought and solidifying its position as a team with the most titles in Mexico. And let me tell you, Damien, the Diablos have done an excellent job capitalizing on their home turf. Estadio Alfredo Harpelú, named after the owner of the team, that is nestled in the Magdalena Mixhuca Sport Complex in Mexico. It's a world-class venue with all the amenities you'd expect from a modern stadium in the US. The atmosphere is fantastic. I've been there a couple of times. I recommend those who haven't to do it. It's fun, it's safe, it's lively, and incredibly entertaining. Attending a game is an absolute joy, different to some of the soccer games that I've also go that are sometimes a little bit more rowdy. Let's put it that way. This vibrant environment is no coincidence. About 2 years ago, the Diablos underwent a comprehensive reorganization that reshaped the team, both financially and operationally. This restructuring not only improved their financial health, but also led to record-breaking attendance during the last season. The team revamped its roster and coaching staff, brought on new sponsors, launched fresh advertising strategies, and assembled a board of directors focused on driving profitability. No wonder Alfredo Harpelú emphasized during the listing celebration the importance of reaching out to Mexico's 130 million citizens to increase the attraction of baseball and invest in the team. This milestone is also a big deal for the Mexican Stock Exchange. It highlights how it can act as a strategic ally, helping sports institutions grow while opening up new investment opportunities. What's next for the Diablos? Well, they are planning a capital increase and a stock split, which they'll propose to shareholders' assembly. The split would issue 100 new shares for each existing one, reducing the nominal value to just 10 pesos per share. This move aims to boost liquidity and make the shares accessible to a broader range of investors. In essence, the Diablos Rojos entry into the stock market showcases the growing trend of sports organizations diversifying revenue streams and improving transparency through public investment. This historic moment doesn't just mark a new chapter for the Diablos, it also highlights the untapped potential for sports franchises across Latin America to leverage financial markets for growth and development.
Thank you for that, Eduardo. It's interesting to understand what Alfredo Harpelu's motivation for making this IPO happen is, because the Diablos doesn't need money. It's a very profitable company, generates a lot of cash flow. He himself is in his 80s. As you may know, he made his money as a stock market trader back in the 60s, 70s, 80s in Mexico. Along with Roberto Hernandez, they bought Axival, which was the leading brokerage house in Mexico, investment bank in Mexico. And they used that vehicle to buy Banamex in the bank privatization.
Correct.
In the early 90s. And then they sold Banamex and Axival to Citigroup for $12 billion. They didn't own all of the company back in 2001. So a very successful financial baseball fan since a kid. Now he decides to IPO. Some people think they might be doing it as a way of more easily leaving the baseball franchise to his heirs. Each one can take shares that they can sell in the stock market should they wish. Some people think the tax is driving this. In Mexico, you only pay 10% tax when you sell at a profit in a stock market, whereas you tend to pay 35% in private transactions. So that might be a reason. And the other, as he mentioned, that they're thinking of a capital increase. So maybe their plan is to buy other sports teams in baseball, maybe even in the US. They certainly have the proceeds to be able to do that, or adjacent sports teams in Mexico.
They do own, as a matter of fact, a basketball team that it's not very well known. And so that's exactly, I think, some of the reasons for the capital increase. They might invest in other sorts of sports. Alfredo also, if I'm correctly, still owns a share in the Padres, a Major League Baseball up in the States, in San Diego. So yeah, and you're right. Just to give you some figures, the Diablos revenue rose 72% last year, reaching, well, it's not a big company still, but it's a medium-sized company with 531 million pesos in revenues. Net profits weren't that well because I guess they're investing a lot in this new merchandise strategy, but they still earned 30.9 million pesos, which is 6.3 less than the year before. So yeah, it's not a company that it's in any shape or form problematic, financially speaking. So yeah, they might be experiencing what you said, the inheritance and how to institutionalize Alfredo Harpelu's heirs, and also probably make it a bigger business in the future.
And you mentioned Oye Imani, the spin-off of Televisa, that originally when they first listed the stock price in the morning, it was at 11 pesos, went all the way up to 50 pesos, then it's come down to 30 pesos or so, with a market value of about $200 million. About 1/3 of its business, about 40% of its business is football, the America Football Club. Another 50% is roughly the casinos that they own, and maybe 10% is the publishing division. But the football team is doing very well. The interest in institutionalizing and professionalizing Mexican football became very clear when Apollo, the big American private equity fund, was reported by various Mexican newspapers to be interested in buying the commercial rights to the football league in Mexico, 10%, and numbers in the newspapers were mentioned at $1 billion or so. And America's, by far and away the most important franchise in the football team.
Correct.
So I think there's a lot more to be done in professionalizing Mexican soccer, and it wouldn't surprise me if Olemani continues to gain strength in the stock market. As you mentioned, they own the Estadio Azteca, and on June the 11th next year, 2026, the opening game of the World Cup will be held at Azteca Stadium. It's currently closed, being refurbished, and the capacity is going to grow to 90,000. The new lights are being put in, new changing rooms. It's going to be a sparkling, newish stadium that has, at the same time, will be the only only stadium in the world that's hosted the opening game of 3 World Cups, 1970, 1986, and now June the 11th, 2026. Let's hope Mexico's national team does a bit better in the World Cup than it's done hitherto, because it hasn't had a lot of success considering how important football is to, or soccer is to the country.
Well, I think what you mentioned about Apollo, it's quite interesting in the sense that it's also professionalizing Mexico's sports system. If I'm not wrong, that transaction failed in the end. I don't know the reasons why, it's not being very clear, but it shows that there is interest in the entertainment sports industry by far from people like Alfredo Harp listing his shares, Apollo coming here. I've heard that some lower division teams have also capital from abroad, and that will probably make sure that these teams perform better, as performance is what drives ticket sales, TV rights, and so on and so forth.
Yeah, I think one thing that some fans say is holding it back is as you know, there's no promotion and relegation in Mexico, which makes it very different to football leagues in Europe and South America,
among other issues.
Great. Well, now I wanted to move on to industrial real estate. Maybe not the most thrilling topic, certainly not as exciting as baseball and football, but it is one of the most crucial sectors in the Mexican stock market, and it's a key driver of nearshoring and Mexican exports to the US. Without industrial parks, there'd be no or little infrastructure to support Mexico's export industry and facilitate the ongoing e-commerce revolution in the country that Amazon and Mercado Libre are heading.
It might not be thrilling, Damien, but you have a good story to tell. You'll see.
Well, last year we saw something, which for Mexico at least was quite exciting. We saw a contested takeover of a publicly traded company in the industrial real estate space, with at least 6 bidders competing to acquire Terrafina, which was the Prudential managed Mexico REIT, or FIBRA as they're called here, for mature real estate assets. The different bidding parties included Blackstone with its local partner MRP, the US's Prologis, its Mexican arm, known as Prologis as well, Fibra Uno, which is the largest REIT in Mexico, Fibra Monterrey, a smaller but very focused industrial REIT in the north of the country, Fibra Macquarie, which is the REIT sponsored by the Australian infrastructure powerhouse. There was also an offer on the table from Terrafina's management, to keep going as an independent company with internalized fees, and there was a bid from another undisclosed party, possibly Grupo Mexico and its real estate. Terrafina itself was listed over 10 years ago, had last year about 4.3 million square meters of leasable area, primarily in the northern border states and some in the central regions, and it mainly catered to nearshoring manufacturers, companies, and e-commerce warehouses, and it was worth about $1.2 billion before this transaction. The company's sponsor, the Prudential, as I mentioned, earned pretty good fees from managing the FIBRA, the trust. However, Prudential did not hold majority control, meaning Terrafina's shareholders, mainly Mexico's pension funds, had the power to vote on the independence or on a sale, making the takeover possible. This is quite unusual in Mexico, where most companies remain tightly controlled by the sponsors or by founding families. The takeover process began when Terrafina announced it would internalize its management and end its relationship with Prudential. Presumably, although there's nothing public on this decision arose from differences between Terrafina's management and Prudential over the company's direction and the fees that it was paying Prudential. The announcement of the internalization was like blood in the water, attracting the attention of other FIBRAs in Mexico and real estate funds, all eager to acquire Terrafina's undervalued assets, boost their own management fees, and grow by issuing additional equity. Prudential, presumably, regretted not keeping control of the company when they founded it originally, as some other of the sponsors have done. Even to Prudential's credit, it was following best corporate governance practices by allowing the shareholders to vote on the future of the company. The bidding war was kicked off in February last year and concluded in August. Terrafina's stock price rose from about 30 pesos before the original internalization announcement to as high as 45 pesos, reflecting the different competitive offers and the improvement in the offers over the time. It ultimately came down to the world's 2 largest real estate funds, Blackstone and Prologis. Blackstone made increasing all-cash offers, culminating one for about $1.5 billion US, while Prologis countered with improving bids in a mixture of cash, went up to 1/3 cash and 2/3 of its stock of its local Mexican vehicle. Blackstone at the time questioned the Prologis's tax ability to limit tax by buying out Terrafina, and that for a time became a big stumbling block in Prologos's bid. But in the end, Prologos won through. It appealed to the synergies of its merger, was able to eliminate a lot of costs by putting the two assets together. Blackstone, unlike Prologos, has no meaningful presence in Mexico, and so it wasn't able to benefit from these synergies. Also, Prologos was able to go to the shareholders of Terrafina, which were mostly the same shareholders of Prologos, and say, this will not only benefit your position in Terrafina, but it will also benefit your position in Prologos, which will benefit from these synergies. So you should look at this as a combined offer, and that probably swayed the opinion of many of the pension funds. It's worth mentioning that during this, by far the biggest real estate player in Mexico, Fibra Uno, or Funo as it's known, had been planning to IPO its industrial division in an entity called Next, but that was pulled when Next failed to get tax approval from Mexico's finance ministry. It then wanted to get around the problem of not having the approval to IPO Next, wanted to buy Terrafina to reverse merge its industrial assets into Terrafina, which it would keep as the listed vehicle. That deal was too complex for the market and would have required shareholder approval instead of just people voting in a tender offer. So that, in the end, didn't progress. The decision hinged on the pension funds, especially Citi's pension fund in Mexico, Citibanamex Afore, which was a key shareholder in both entities, both Prologos and Terrafina. And as it happened, its parent company, Citigroup, has long been an advisor to Prologos. Citi's pension fund supported Prologos, perhaps reflecting its position in Prologos. And Terrafina, almost all of Terrafina, was absorbed into Prologos Mexico by the beginning of this year, and it's become the largest real estate in the country. Looking back, the outcome has been a bit mixed. Prologos stock prices has performed poorly since the deal, reflecting fears of Trump imposing tariffs on Mexico. Had Mexico's, with the benefit of hindsight, had Mexico's pension funds accepted Blackstone's all-cash offer, Terrafina shareholders would have done better, because Terrafina, which still remains listed, has seen its stock price fall to about 33 pesos. And if you take the 1/3 in cash and the 2/3 in Prologos price, which is also down more than 20%, you get to a lower price than Blackstone's all-cash offer. And also, I think there's some disappointment in the market that Prologos has some of the higher fees, that Prologos sponsors some of the highest fees in the market, and there had been hope that Terrafina's plan to internalize would have led to other Fibras internalizing and reducing the operating costs of the different REITs to the benefit of shareholders. But in the end, that didn't happen, and Prologos, although it has cut its fees a bit, remains as the external manager of this REIT. And that's a key differentiating factor with US REITs that are now almost all internally managed. Why has industrial real estate in Mexico fallen out of favor? Initially, it was until March of last year when this whole process started. It was a very hot sector due to the nearshoring boom, or what was thought of as the nearshoring boom. Mexico, as we've said in last week's podcast, became the US's largest trading partner in 2024. Mexican real estate stocks doubled from post-COVID to March 2024, far outstripping returns of industrial real estate stocks in the US and Europe. That reflected industrial rents going up a lot, about 30% in dollar terms from 2022 to 2024, as nearshoring excitement gathered momentum. But it's cooled at least that excitement. I think one is that maybe the nearshoring excitement got ahead of itself. The first phase of nearshoring was about FDI being financed by reinvested profits, and about 90% of FDI in Mexico came from reinvested profits. The second phase was going to be greenfield FDI from new players. For example, Tesla announced that it was going to build a $5 billion plant near Monterrey. That second phase hasn't really happened. Tesla cancelled its project, and FDI that we're seeing is almost all financed by reinvested profits. Obviously, fears over Trump's tariffs have dampened the nearshoring momentum, and that might have been behind Tesla's decision to cancel the plant. Then you have concerns about Mexico's political direction, as we talked about before. From after Claudia Sheinbaum won the election in June of last year, there's a series of constitutional reforms that have, in the opinion of many, eroded checks and balances in Mexico, such as the elimination of the current judges and their replacement by elected judges that many people think is a backdoor way for the current party to control the judiciary system. There are persistent infrastructure issues that are affecting industrial real estate, especially in energy. There's a shortage of energy, and I'm aware of a couple of big companies that want to continue expanding in Mexico, but they aren't able to do so because there isn't enough energy. And then entry barriers, especially in northern Mexico, there's plenty of land, perhaps not as high as people thought. So the amount of new industrial parks has exceeded absorption even before Trump won. So we're seeing vacancy rates in Tijuana, Reynosa, Juarez grow from basically 0% in 2022 to vacancy rates of 4, 5, or 6% last year. So even before Trump and before Sheinbaum won, we were seeing some troubles in the industrial real estate sector. USMCA related to the Trump and tariffs is probably the biggest concern there. As you know, USMCA was actually signed by Trump back in 2020 at the very end of his term to replace NAFTA. Under USMCA, there is an agreement to potentially tweak it in 2026, the so-called sunset clause. People are very concerned that that Trump may take advantage of that to try and undermine USMCA as it currently is, or even cancel it. And with a 6-month notice period, you can exit USMCA. Under the original terms, USMCA was set for 16 years, which would take you to 2036, and then can be renewed for another 16 years. But this combination of being able to exit with 6 months notice or the 2026 sunset and Trump's stated interest in putting tariffs have raised concern and led the industrial stocks to perform quite poorly. So what's the outlook? Nearshoring continues to drive demand for well-managed industrial parks, and Mexico's peso, partly because of Sheinbaum and the so-called Plan C, Trump has moved to 20.5 against the dollar. So that from 16.5, so that 20% devaluation potentially discounts any potential tariffs, or certainly offsets them. In addition, because stocks have performed poorly, asset prices are below replacement value. So it's a good contrarian bet, some people think. And the players in the stock market have lots of advantages over the more private, informal players. They can negotiate better terms with tenants. They have probably more access to energy and water. So even if the broader sector remains a bit challenged, the hope is that there'll be some consolidation benefiting players like Prologis or some of the other players like Macquarie or Fibra Uno or Vesta, which is another listed industrial real estate company, or Fibra Monterrey. It'll also be interesting to see what Blackstone does. They're probably happy that their bid wasn't accepted because they could buy the same assets today at a lower price. They can potentially buy one of the other players if they're available. And even Prologis itself has announced that after buying Terrafina, they're looking to sell as much as 50% of the assets in Terrafina, mainly in the markets that Prologis wasn't present in. So a lot of assets are potentially on the market. So I think Blackstone might come back with its Mexican partner, MRP, and take another look.
Quite interesting. If I listen to the people that I'm talking to about Trump and tariffs, my bet is that the real estate market will come back. The reason is that, yes, Trump will impose tariffs at the beginning, but long term, he will probably retrieve them from the Mexican export sector. And he might do it strategically. So after listening to what you just said, I think maybe it's the right moment to go back and look at these properties and some of the managers that are handling these properties, if one bets that Trump will come to his senses in terms of not imposing tariffs that might hurt him from a growth and inflationary perspective.
Yeah, and you have a hedge to some extent because most of the rents are in dollars. And if Trump carries through on this tariff threat, the peso will devalue, which will offset some of the tariffs. And meanwhile, you're collecting the same rents in dollars. So there's something that protects you a little bit from Trump, although clearly a best case scenario would be that Trump in the end reaches a deal, as he did in 2020 with Mexico.
Exactly.
And excludes it from potential tariffs on other countries. At the same time, there's been another takeover battle in Mexico, much smaller, much less high profile. There's also in the real estate sector, there's a listed shopping mall entity called Costa Verde. It has shopping malls mainly in northern mid-sized towns across Mexico, and they received a takeover offer from Grupo, which is another mainly shopping mall real estate company owned by Mexican billionaire Germán Larrea. And the Costa Verde's, one of its shareholders is the late Sam Zell's Equity International. And they accepted this offer, but the controlling shareholder for Costa Verde, another Mexican billionaire called Fernando Chico Pardo, rotundly rejected the offer and then put in place a poison pill to buy back 40% of Costa Verde's shares. Oh. And as far as we know, that's where things stand. And Germán Larrea and Fernando Chico have had a rivalrous business relationship for a long time. At one point, Fernando Chico Larrea tried to buy a stake in Azur, the airport operator for Cancun, and forcing Fernando Chico to exercise his first right of refusal on that stock, but at a higher price. And ever since then, And maybe beforehand they've been rivals of sorts.
I remember that story because I did interview Fernando Chico Pardo back then, and he just said, well, he just made my business deal more expensive. Not sounding too happy about it.
Great. So what else do you have for us today, Eduardo?
Damien, let's shift gears a little bit to another topic. Very interesting topic always. Mexican billionaire Ricardo Salinas Pliego, who did not have, let's put it, a great 2024. As you know, he's the owner of Grupo Elektra, the retail and banking powerhouse, along with other major enterprises controlled by him and his family, such as TV Azteca, Mexico's smaller broadcasting company, and the telecommunications venture Total Play. Salinas Pliego, who's anything but shy among Mexico's billionaires, has recently found himself in the spotlight, but not in a way he'd preferred. He's been making headlines for all the wrong reasons, may I add. So much so that his troubles have even come up during President Claudia Sheinbaum's daily press conferences. This time, Salinas is facing several financial controversies, particularly regarding loans secured by shares of his Elektra company and allegations of default on those obligations. And if that wasn't enough, he's also been labeled as a tax evader. Let's start with the loan dispute, Damien. Back in August, Astor Asset Management III, a financial institution specializing in independent financing and liquidity transactions, accused Salinas Pliego of defaulting on a $110 million loan arranged in July of 2021. The loan was reportedly secured by 7.2 million shares of Elektra. Corporación RBS, a company controlled by Salinas, acted as the borrower, with Salinas himself as the guarantor. Astor Asset Management alleged that Salinas breached over 15 provisions of the securities lending agreement, including failing to make interest payments. They also claimed that he violated Mexican security regulations by failing to disclose the share pledge publicly. What is a legal requirement here. Salinas, however, has fired back, asserting that he was the victim of a multi-million-dollar fraud. He stated that he had initiated legal actions again in response, making it just another chapter in the life of Tio Richie, as he sometimes called for his folksy, down-to-earth public persona. But that's not all. Grupo Elektra faced another significant financial blow last year. In June, a Mexican court ordered the company to pay approximately $1 billion in back taxes. The ruling rejected an injunction filed by Elektra to overturn the tax authorities' claim. Grupo Salinas announced its intentions to appeal the decision, possibly taking the fight all the way to the Supreme Court. These financial and legal challenges have taken a toll on Grupo Elektra's market performance. In July 2024, trading of its shares was suspended due to the dispute with Astor. When trading resumed, the stock plunged by over 70%. Raising more than $5 billion from Salinas Pliego's wealth and marking its worst performance in nearly a decade. Adding to the pressure, in December, President Sheinbaum publicly addressed Grupo Elektra's tax obligations, emphasizing that no individual or company is above the law and that everyone must pay their dues. These controversies paint a complex picture of Salinas Pliego and his business empire as we step into 2025. Issues of corporate governance, regulatory compliance, and financial accountability are once again front and center for him. However, to his form, Salinas is putting up a fight. He's even taking steps to make Elektra a private company again after 30 years on the Mexican Stock Exchange. At the end of last year, surprisingly, the board approved the measure, and notably, Salinas and his relatives were removed from the board entirely. Taking over as chairman is one of Salinas' most trusted lieutenants, Pedro Padilla, who has worked with him for over 3 decades. So it's not clear whether the removal means anything. It's clear this story has many chapters left to be told, with Salinas emerged scratched but standing, as he has so many times before. Only time will tell, Damien. What do you think?
I think that Elektra being a private company is in everyone's interests. I think it's in the interest of the minority shareholders to be bought out at least at book value, which is what is required under Mexican securities law. The stock after the collapse was below book value, so they'll do better than where the stock price was. And I think for Salinas, it gives him full control to do what he wants, which, however you look at it, has been an immensely successful company. So I think the outcome, if it gets confirmed, of being private is the right one. He also got some good news because he has another business, Total Play, which is one of the top 3 broadband companies in Mexico offering internet and cable TV. And they were under a lot of financial stress. They announced an exchange offer for their bonds, and basically the exchange offer will give existing bondholders a coupon of over 11% from 6%, but will also require them to put in over $200 million of extra money into the company. And it looks like more than 50% of existing bondholders have agreed to that. And there's been a huge rally in Total Play's bond price on that basis. So some good development on his cable business, on his broadband business.
And I think Salinas Pliego will have no problem in raising the capital for him and his family to buy back the shares from Elektra.
Yeah, I mean, I don't know, but it's a good business. It includes Azteca, a huge bank. So I'm sure there'll be ways of finding the proceeds to take it private. The free float's not very big, so it's not a lot of money in absolute terms.
That's correct. Yeah, that free float has also been quite controversial in terms of the fight he had with previous president of the stock market trying to take Elektra out of the index, and it was a rough battle between Luis Telles and Ricardo Salinas back then. So also I think in that sense, Ricardo could take care of his company and, like you said, do what he wants to do with it. He was with Elektra an entrepreneur in terms of the loans that it gave to low-income Mexicans. He set up a model that was then imitated by others, and his presence grew tremendously under his leadership. So I think he wants to probably get rid of that headache that Elektra has become sometimes because of its public presence.
That's right. Talking about the retail sector, and just to finish, another pretty important cross-border deal was announced this month, which was Puerto de Liverpool, to give its full name, Mexico's largest and leading department store chain, teamed up with the Nordstrom family to take Nordstrom US department store chain private. The Nordstrom family took 51% of the company and 50.1%, and Liverpool 49.9% at $24.25 a share, which was a 42% premium over the pre-bid speculation price. That gave Nordstrom a market cap of about $4 billion, enterprise value about $6 billion. Put that in perspective, a decade or so ago, Nordstrom was worth $15 billion. It's been brutally affected by Amazon and e-commerce and changing trends in purchasing in the United States. Liverpool already owned 10% of Nordstrom before this announcement and will basically invest another $1.7 billion from its existing cash balances to take its stake to near 50%. Some interesting facts about Liverpool. It's actually much more profitable than Nordstrom. Its net profit last year about $1 billion, double Nordstrom's. Its EBITDA is also larger, at 1.5 billion versus 1.3 billion. Liverpool in Mexico has much more focused on shopping centers. There's 29 shopping centers, by far the largest shopping center owner in Mexico. Has 124 Liverpool department stores. It's very large in credit. It's top 3 credit card issuer in Mexico, has nearly 8 million credit card clients, and it recently bought from Walmart Mexico 188 Suburbia stores, which is a slightly lower end department store chain that didn't really fit with Walmart's kind of general merchandise discount strategy. Liverpool, funnily enough, is actually much older than Nordstrom, which itself is over 100 years old. Liverpool was founded in 1847 by a French immigrant called Jean-Baptiste Ebrard, who sold clothes from his trunk. He named Liverpool because he imported goods from France that were then shipped to Mexico through the port of Liverpool in England, and that's how it came by its name. Anyway, Jean-Baptiste was very successful. He turned his trunk shop into a much bigger shop in 1851, what's now called Madero, in the Centro Histórico. It became the biggest shop in that part of town. And Ebrard was actually the great uncle of Marcelo Ebrard, Mexico's economy minister, who's responsible for renegotiating potentially at least USMCA with the Trump administration. And Marcelo Ebrard, formerly also mayor of Mexico City, writes quite a lot about his great uncle in his book that he came out when he tried to be the presidential candidate of the Morena party called El Camino de Mexico, and talks about how important Jean-Baptiste was to the family. But Liverpool didn't actually open its first department store rather than general merchandise shop until way later, until 1936. And it was in an iconic Art Deco building in the historical center, designed by a then most famous architect in Mexico called Enrique de la Mora, who was the same architect for the Torre Latinoamerica. And that building, which you can visit, sported Mexico's first ever elevator. Anyway, Liverpool went public a very long time ago, by Mexican standards at least, in 1965, making it just a year younger than me. And it opened its first shopping mall in Perisur, which is still going strong, in 1980. And then it expanded outside Mexico for the first time in 1982. It went to Tabasco. That was its first store outside Mexico City. And by 2014, it got to 100 stores. And now, as I mentioned, there are over 124 Liverpool and the shopping centers and the suburbias. So from a small trunk in downtown Mexico 170 years ago, Liverpool has grown into Mexico's largest department store chain, largest shopping mall chain, a top 3 credit card company in Mexico, and now owns half of one of US largest department store. So well done, Jean-Baptiste Ebrard.
I gotta say, Damien, when I first heard the acquisition that Liverpool announced in September of 2022 of the 9.5% stake in Nordstrom, and maybe I'm a bit crazy, but it immediately reminded me of another Mexican company which ventured abroad and has been able to do what American companies have no longer been able to do. And I'm talking about Grupo Bimbo, which is a bread maker here, which expanded into the US and has consolidated its presence in the US. And I was wondering if El Puerto de Liverpool was going to be the Bimbo of retail department stores in America, where the American companies are no longer able to compete against the e-commerce. And here is someone who has a different way of doing things, probably, and thinks that its model can be replicated abroad and save something that might be on the decline. I don't know, I'm just speculating. But it shows how the integration of US and Mexico is not one way, but 2 ways in terms of companies buying companies here and Mexican companies also buying companies in the United States.
Yes, I mean, Bimbo has grown in the US through purchase acquisitions, basically using its very substantial cash flow in Mexico. But the return on capital of those acquisitions in the US, remains far lower than the return on capital in Mexico. So they've been able to very successfully diversify their business, but they haven't been able to replicate the success they have because they don't have the same market share, and it's complex managing businesses in the US. But for sure, and Bimbo owns its businesses, all of its business in the US, and right now at least Puerto Liverpool is a minority shareholder. But there are definitely similarities, and Mexican companies, and it's not just those two, there's plenty more, have been expanding into the US as a way of diversifying, and companies like Gruma have taken advantage of the very large Hispanic population in the US to sell tortillas and related products. So they're not just diversifying, but using their know-how with the Mexican consumer in Mexico to appeal to the same or very similar Mexican consumer now living in the United States.
Correct. There are various examples of such transactions, and yes, generally Mexico is their prime source of capital flows with which they can expand abroad and probably keep those companies afloat and injecting them certain know-how that their former owners did not have. So it'll be interesting to follow what Liverpool does in the Nordstrom sphere.
That's it for this week's top Mexico business and finance stories. Thanks for tuning in, and we'll see you next week on Mex Movers by White Paper Media.
Thank you, Damien, and thank you everyone for listening.